Welcome to the deep dive. Today we're tackling something really important for understanding company value, intangible assets, specifically the ones with indefinite lives. We're using the materials you sent over.
Right. These are those long-term things, legal rights, competitive advantages, not physical stuff.
And our mission today is to kind of unpack what they are, why they matter, and, how companies actually account for them. Cut through some of the jargon.
Exactly. And you can sort of split them in two, right? There are ones you can specifically identify, patents, copyrights, that kind of thing.
Okay.
And then there's the stuff that's harder to pin down, like goodwill. That's the big one we'll focus on.
So, indefinite life. What makes them different? Is it just that they last forever?
Well, not quite forever, but there's no foreseeable limit. No contract ending, no law saying it expires, no obvious economic reason. It'll just start being useful anytime soon.
Got it. And goodwill is the classic example.
It really is.
Which brings us to something interesting you mentioned. Companies don't amortize these indefinite ones.
No, they don't. No gradual write-down year after year. Instead, they sit on the books at cost, less any impairment losses.
Impairment? Okay, we'll need to get into that. But first, goodwill itself. What is it, fundamentally?
It's like all the extra value that comes from things you can't put on a separate line item, maybe great management, a super strong brand reputation, some kind of secret sauce, It represents that extra earning power beyond just the assets you can list out.
But here's a key point, right? A company can't just decide it has valuable goodwill.
Absolutely critical distinction. We only recognize goodwill as an asset on the balance sheet when one company buys another one.
Ah, so it arises from acquisitions.
Yes. It's basically the amount the buyer pays over the fair value of the identifiable net assets they got.
Right.
You can't just in turn and decide your own reputation is worth X million and put it on the book.
Okay, that makes sense. So in a buyout, it's purchase price minus fair value of the identifiable stuff.
Pretty much, yeah. The excess becomes goodwill.
And if a company spends money maintaining its brand or reputation after the acquisition, does that increase goodwill?
No, that's a common misconception. Costs to maintain or, develop goodwill further, those are just expensed as they happen, not capitalized.
Right. Okay, back to impairment. These indefinite life assets, goodwill included, need testing. Let's start with the ones other than goodwill.
Sure. So those need checking for impairment at least once a year.
Annually.
Companies often start with a qualitative assessment. They look at factors like the market, their own performance, legal changes, stuff like that.
Kind of a preliminary check.
Yeah, to see if it's more likely than not that's the threshold that the asset's value has dropped below what's on the books. They can skip this step and go straight to the numbers, though.
And if that qualitative check flags a potential issue or they skip it, then what? The quantitative test.
Exactly. Then you compare the asset's current fair value to its carrying amount. If fair value is lower.
Impairment loss.
Yep. Recognized in income reduces the asset's carrying value. And generally, you can't reverse that loss later if the value recovers.
Okay. Now, goodwill impairment. Similar idea, but it's tested differently at the reporting unit level.
Right. Think of a reporting unit as a distinct chunk of the business, an operating segment, or maybe one level down. Goodwill gets tested there.
And there's a qualitative assessment option here, too.
Yes, same idea. Check the relevant factors for that specific unit.
And the quantitative test for goodwill. How does that work?
You compare the fair value of the entire reporting unit, including its allocated goodwill, to its carrying amount, which also includes the goodwill.
Ah, so the whole unit's value.
The whole unit. If the carrying amount is higher than the fair value, then you've got impairment. But there's a catch. The impairment loss you record can't be more than the actual amount of goodwill allocated to that unit. You can't write down other assets through this test.
Got it. Protects the other assets. Your materials had that Omega Inc. example showing this clearly.
It walks through calculating the loss for different units.
Now, private companies get a bit of a break here, don't they?
They do have alternatives. They can choose to amortize goodwill, usually over 10 years, or less if they can justify it.
Wow, okay. So they can amortize.
They can elect to. And they don't necessarily need to test for impairment every year, only if a triggering event happens. Or they can just stick to the qualitative assessment each period. More flexibility.
Definitely sounds simpler. Let's switch gears quickly to R&D research and development. Very different accounting treatment here.
Oh, yeah. The general rule. Expense it immediately.
Why is that?
Because the future economic benefits are just so uncertain at the research stage, you don't know if anything will come of it.
Makes sense. But there must be exceptions.
Three main ones. First, if you buy tangible assets like equipment for R&D, but they could be used for something else later, you capitalize the equipment and depreciate it. That depreciation can be part of R&D expense, though.
Okay. Exception 2.
If you're doing R&D work under contract for someone else, then it's basically a cost of providing that service, so cost of sales.
And the third,
When you buy another company, any R&D projects they already had in progress, in-process R&D, that gets capitalized as an asset initially.
right, and things like routine tweaks or market research, those aren't R&D for this purpose.
Correct. Those are expensed differently, maybe as regular operating costs or selling expenses.
Okay, last area, computer software development. More specific rules again.
Yep, and it depends. Is the software going to be sold or licensed, or is it just for internal use?
Let's start in software to be sold.
Okay, you expense all the costs until you hit technological feasibility. That usually means you have a detailed design or a working model.
Right.
After that point, up until the software is ready to be released, you capitalize the costs. Then you amortize that capitalized amount.
And internally used software.
Simpler in some ways. You expense the early preliminary project stage costs and things like training and maintenance. But the costs during the actual software development phase, those get capitalized. Then you amortize them, usually straight line.
Okay, wow, a lot of nuances there.
Yeah.
So, quick recap. Indefinite life intangibles, like goodwill, no amortization, but annual impairment tests are key.
Goodwill itself only comes from acquisitions, and maintaining it is an expense.
R&D costs,
Yeah.
mostly expensed right away due to uncertainty, barring those few exceptions.
Right. And software costs depend entirely on whether it's for sale or internal use, dictating when you capitalize versus expense.
Understanding all this really gives you insight into how companies value, well, the invisible parts of their business, which are often huge drivers of success today.
It absolutely does. And you see the judgment calls involved, especially with fair values and impairment. It's crucial for reading between the lines of financial statements.
Definitely. Which leads to maybe a final thought for you to consider. Given how much modern value is tied up in brands, data, knowledge, these intangibles are our traditional accounting rules really keeping pace? How might they need to evolve? Something to think about. Thanks for joining this deep dive.